Hello, good morning, everybody. So today we wanted to talk about asset management and how it's going from digital to traditional. And we have a great panel of speakers here next to me. Maybe we can start with a little bit of background on where we are today in asset management. So reports coming out on asset management and the great convergence. You have the assets under asset management have reached 147 trillion end of last year and projected to be reaching around 200 trillion by the end of this decade. Other reports are showing that you have $200 trillion by the end of 2023, compounding at 6%. And you have Oliver Wyman's report also recently came out showing that there's a shrinkage, despite this increase in number of assets and the size of assets, you have a shrinkage in the asset management firms that are going in to the asset management business. And already, also interesting, the top 10 firms and asset managers hold and control 57% of assets under management. So you see a lot of concentration. And towards that, we were going to talk about 4 themes today. Those themes are the consolidation happening in the portfolio construction of asset management, what counts as an asset, what has happened to the definition of asset, and what counts as an asset. And thirdly, the new asset management operating model under the impact of AI and what it's doing to the asset management firms. And lastly, the fairness, access, and regulation to the asset management. But let me first start with allowing my panelists to introduce themselves, starting with Wahid.
Great. Pleasure to meet you. I'm Wahid Chammas. I own a private equity firm called Tiergate Capital. I spent my last 35 years sort of a third, sell-side Goldman Sachs, 1/3 at Janus Henderson doing $400 billion fund, traditional long only. And then I flipped completely the other way and started my own PE firm. One of my more famous stakes is the Attention Company. It's the first unicorn going public early next year, built out of X. It's founded by Mario Naufel. It is a media conglomerate, a 300 million plus VC arm for digital assets, and also a burgeoning accelerator of companies.
Awesome. My name is Matt Szilagyi. I'm the Chief Investment Officer of Aspen Digital. Aspen is a private bank for digital assets. So we're a fully licensed firm in Abu Dhabi Global Markets, just right down the street. And we service ultra high net worth family offices, sovereigns, and institutions that want to do anything within a walled garden. So clients can trade through us, stake through us, do structured products. We recently launched the Coinbase Bitcoin Yield Fund, where they're a distribution partner here in the UAE and in all of Asia. We have several different fund of funds platforms. We do direct secondaries. And prior to Aspen, I was running the blockchain practice for a firm called Ackley Partners in Washington, D.C. They're the largest institutional allocator to crypto venture funds globally.
Thanks, Mac. Hi, everyone. This is Ray Tam. I'm the co-founder of REVO's Family Office. Also, it's the CEO of REVO's REVO Digital Family Office. So REVO itself, it's Asia leading multi-family office that do headquarters in Hong Kong and Singapore, where REVO is the dedicated digital asset arm for REVO. So we started off with really traditional asset class, right? Fixed income, FX, private equities. 4 years ago, we have REVO, why REVO? It's the REVO's evolution. So we see the digital asset as an asset class, not just as an asset class, but the importance of the digital transformation of the whole investment flow. So that's what we do. And we are celebrating the 10th anniversary this year. So happy to be here in Abu Dhabi and going to have something fun next year here as well.
So thank you, gentlemen. Based on what we've talked about, and we started this panel about the concentration of assets being managed by the top 10 firms, is this becoming a winner takes most or takes all environment? And is there an honest to market alpha? And how can you guys focus on creating that alpha in your portfolios, given that the concentration of wealth is happening? And all of you are developing firms that are at the cross-section of, or the bridge between digital and traditional assets. Starting with you.
Yeah, I'm going to answer this maybe different to what you expect. When I was at Janus Henderson, very traditional, $400 billion fund, you'd think it would be Herculean, high-powered, et cetera. And actually, when I was a portfolio manager there, part of the reason why after 11 years I decided to do my own thing was 85% of the investment decisions were sort of preordained. You had to buy Nestle. You had to buy BP. You had to buy the big companies.
Following the index.
You had to follow the index because underperforming and doing certain things that are truly alpha seeking, real deployment of capital, and I love Janus, they're amongst the best in their categories, so there's no criticism. But to your question, these very big funds that control trillions and trillions of dollars, they do the same thing. And so, taking it to the extreme, and it wasn't as extreme back in my days, today, 37% of the index is 7 stocks. So it really takes price discovery out of the market. So to flip the page completely, when I started Tiergate Capital and then do really interesting things like the Attention Company, you're really going after entrepreneurs, and it's pure alpha. There is no beta, right? Maybe there's a little bit of beta in the sense that markets go bad and then they have a hard time raising money and surviving. But at the end of the day, it's all alpha. It's all deploying capital to people who really need it, who could really use it, and not just sort of go through the whole hamster wheel.
But interesting, if I can challenge you a little bit
Yeah.
on that, Wahid. You see all of that concentration of wealth. There's a lot of following and herding, and a lot of wealth is being concentrated in 7 companies, as you mentioned. How is the line being blurred between active and passive? What is the added value of a fund manager?
Again, very difficult. To speak as a fund manager for 11 years, I became irrelevant. If you are playing in the large cap space, you've got to make a case for passive. So in my view, to cut to the chase, people need to be in passive and in high alpha, private equity, VCs, or ultra micro cap and small cap. Okay, that middle ground does not play. And proof of it is in the numbers. 75% of fund managers underperform. So what's the point? Right? If everyone is trying to hug a benchmark, then you've got this monkey on your shoulder, you don't really get alpha. So against that backdrop, that world of active, passive, especially in the large and mid-cap space, I think is evaporating. And what you're seeing is passive and then ultra small cap, micro cap, private equity, digital assets, really bridging the gap of people who really need capital and accessing a different way.
How do you see that, Ray, from your side, from your point of view? How do you manage the family offices, and how do you pitch those investments and the alpha versus the beta to your investors?
Well, from the family office's perspective, most of the time the decision making is basically based on what is upcoming, obviously, right? But more importantly, I think it's the allocation. I think how do you allocate the assets according to what your mandates, what your family constitution, how do you actually want to bring this wealth to your next generation? So first, the investment horizon for most of the investors that we have in Asia, mostly they're quite long. So I think the first key thing that we always want to look into is how do we do it efficiently, right? So I'll give you an example, right? In the past, I would say 2-3 years, right? I can definitely say that where the alpha comes from, it's always from concentrating on the AI related PE investment. We're the early investor in Anthropic, XAI that we mentioned, Cerebras, all these, right? But also importantly, digital asset as well as an asset class that upcoming on that. But more important for the investor's point of view, right, is how do you have a dedicated team and expertise that can actually help you on that. One quite interesting figures that we have, right, out of Hong Kong and Singapore, I would say actually 60-70% of our clients, they have their own single family office. But why do they still need some, I would say assist or even allocating some of the assets or outsourcing to multifamily office like us? Because you need to have teams basically that can look into different asset class. Also, I think one thing that we mentioned earlier, right? What's the impact of the technology, right? I'm sure that with the AI coming in, right? AI just become the second CIO that you have. In the past, right? When we deal with the traditional assets like equity and fixed income, FX, there are like 400 reports sent to our email every day. I don't think our analysts, PM, CIO is going to read that all. So with these support with the technology, right, they basically consider it become few key points. So you make decision based on these as soon as you basically get in the morning, right, into the office. So I think the key for that is how do you actually allocate and make decision more efficiently via what we have seen in the technology impact, as well as the impact from the AI in the coming future. And it's not a future anymore. I think it's happening right now.
Okay, so I want to bring Matt into this. So you just recently moved from the US after a long career in the US. How are you finding this market with regards to the topic?
Yeah, so I mean, maybe for quick reference, my prior firm, about 80% of our $9 billion in AUM was U.S. endowments, pension funds, and a lot of the, I'd say, discourse was around education, or getting them off of zero, getting them into the asset class, and the most logical thing is Bitcoin, right? But then the next question is, what else is there, right? So Wahid's point, right? If you have been in the liquid space, right, and most altcoins are down 40, 50, 60% plus from their all-time high, right? You're probably underperforming if you invested into any directional manager. So you're seeing a lot of allocators that are holding Bitcoin, and they want to be able to generate some yield on that Bitcoin, right? So they're looking for optionality there. They're looking for market neutral strategies to generate, instead of 4 or 5% in treasuries, 8, 10, 12%. And then they're looking high alpha, right? So they're looking to Ray's point, to outsource those investment decisions in terms of venture capital to people that have the network in this space, know all the GPs, know founders, actually can get on a call with a founder. And I'd say founders are oftentimes the best, the leading indicator of who's a good investor, right? If you're investing in the seed round and someone wants to work with you, right, that is a very strong flywheel. And that's why you have these big brands today, because they had very, I'd say, good track records of scaling businesses. So that's largely the role that we play. And yeah, I'd say that Bitcoin yield, market neutral, and then crypto ventures where we're seeing most interest.
Okay, so we've crossed right into Bitcoin. But speaking of real world assets and tokenization, that's now a theme that's happening and taking place. And we expect the definition of an asset to evolve as everything is now tokenizable. Any economic interest, any piece of a building is now can be tokenized and sold. How are those marketed within each of your firms and each of your domains? And how are investors making the move from the traditional asset allocation we just talked about into tokenized assets? From Wahid?
Yeah, absolutely. So, we've been around since 2017, at least the company that I bought, IBC, and the Attention Company. And we've worked with, over 700 projects. So we've seen all the life cycles, ranging from memes and silly things all the way to, gaming companies or DPEN or RWAs. The way we do it is we think very smart entrepreneurs can build amazing things, but it becomes largely irrelevant if no one knows about it, okay? We feel very strongly about that. So especially in crypto, which is very decentralized, having a media mouth, having attention is like probably as important, if not the most important thing for a young entrepreneur to be able to crowdsource funding, because that's what crypto is, right? It's crowdsource funding, and having their innovations known. So in our media, in our shows, and we have the largest shows on X, we get a lot of outreach. For instance, in Dubai, we did a lot of things on real estate RWAs. They needed a crypto audience. They come from the traditional world. They had no idea. Damak and a few others. They had no idea. So to be able to introduce our communities and our tokenization prowess to very mainstay businesses, very powerful. We're doing that in rare earth mining. We're doing that in things that are very esoteric, genomics. 23andMe, people don't like it. People like to put their DNA out there and find out where their ancestors are from. But people took that data, having that decentralized, decentralized genomics, very, very important thing. So we were right there at the right time to approach this project. So it's a lot of getting projects to understand the blockchain, trying to understand that source of capital, and encouraging them to adopt some form of tokenization.
And maybe just to follow on, and maybe I'll also tie Matt into this. How is this region different in creating RWAs and choosing their choice of blockchain or choice of medium in terms compared to the West?
I mean, from a, I'd say a high level standpoint, the UAE in general is miles ahead of the US from a regulatory standpoint. You have buy-in from both VARA and the FSRA. One of the things that our platform is effectively credibly neutral. So we plug in with different providers. So one of the things that we are actually at a call with it last night, there's a company called Superstate, and what they offer you is tokenized money market funds, right, or a tokenized cash and carry trade, right? We integrate with them, right, and we're actually educating the regulator. We can actually get them up to speed on what this company is doing, what they're bringing to market in 6 months, versus that is going to be years and years and years of lobbying and ultimately 2 steps forward, 1 step back in the US. So you're seeing a lot of people exploring ways to, again, tokenize different assets, but ultimately one of the biggest issues with tokenization is the fact that you need liquidity, right? If you tokenize an asset, that's fantastic, but if nobody wants to buy it, it doesn't really matter, right? So one of the really interesting areas we're seeing interest is actually tokenization of private company shares. So things like XAI, OpenAI, you as a retail investor can't get access to it because you're not accredited or you don't have access yourself, right? And so what if there's a fund, Andreessen Horowitz, for example, they invest into a company, right? They tokenize their investment, right? And then anybody that wants to take secondary on that position can transfer it to that other person's wallet. So that's where we're seeing actually the 2 main areas around stablecoins, money market funds, and tokenized private shares.
So tokenized assets on chain are projected to reach around 400 plus billion by 2030. And that's all thanks to different regulations, different regions competing. Ray, how do you see that from your Singapore market and the Far East and the APAC?
I believe the number that you just mentioned is much more than that. I believe that like 2030, it should be like trillions of dollars on tokenized assets.
I'll share with you the source, but
I mean, this is why.
So there are 2 sources. One of them is 700 billion by 2030, and the other is
Are you including stablecoins?
Sorry?
Is that including stablecoins?
I'm not sure. It's just a PwC report projects that tokenized funds under management are going to soar from 90 billion in 24 to 700 billion in 2030. I don't think anybody knows the answer, even if you think it's going to be higher. Let's focus on the drivers of that number. And how do you compare regulation in Singapore, Hong Kong, and that part of the world compared to the Middle East, particularly UAE, and vis-a-vis the US?
Sure, and before that, right, so I was going to share this because when I look into the topic today, right, so I was looking at, you're competing for the capital, right, on that. But I think the fact that is being able to deal with, or basically the whole entire chain of investment has to be on chain, automated, and basically backed by AI support, right? I mean, that's something that all the family offices should really look into. If not, basically you're not about competing the capital, but I think it's about survival. That's the truth, right? I mean, I can share with you a quite interesting story, right? Because when we started Raffles 10 years ago, right? I mean, all the high net worth individuals, one thing that you're trying to solve the problem is I wanted to see a holistic view of my assets, right? As simple as that. If I have like 10 private banks, right, I want to see my position across all the banks. Back then, I think technology-wise, it's not a problem. You have API connected to all the banks and everything, right? However, there's a problem with the alignment. There's no regulation that actually get the banks to align that this is the coffee, this is the water, they said this is the orange juice, they said this is apple juice, right? So the fact that is when we see blockchain, when we see chains that you can basically digitalize or even tokenize asset on that, you can solve the problem from day one. Which means that now we're looking at not just BTC, Ethereum as a digital asset, but if in the future you have all the assets being tokenized, the first thing that was solving for the high net worth individuals was actually just to view what happened to my portfolio. I think that's something that we're solving from day one. The next stage, I'm pretty sure that how are you going to deal with it, manage it, and also even provide liquidity out of it. So that's what we are looking at when we set up REVO. That's something that you have to deal with. So it's not just about digital asset itself. We're talking about 3 trillion of market cap here. And you just mentioned, right, the tokenized asset that we're managing, where we're looking at to, in the coming 1 or 2 years, right, it's going to be 2-3 trillion. I mean, last year alone, if I get the data right, tokenized money market fund is already exceeds 2 trillion, which means that all the asset managers like ourselves, right, you can trade MMF, right, with T plus 0. It's no longer T plus 2 on that. I think that's the fact. So I think with the support by the regulation, which I think in Hong Kong and Singapore, in the past 2-3 years, I think Asia is quite, I would say that, not ahead of US and everyone. Abu Dhabi is where we're also looking at the moment. But I think the key is because if you're looking at the traditional investor point of view, something that they want is the comfort and also being regulated or governance, right? So I think Hong Kong, Singapore actually did a quite, I would say, quite a decent job in here, allowing the ETF onboarding, I think last year in Hong Kong, license exchange in Hong Kong as well, tokenization in Singapore. I think that's clear. I mean, like 3-4 years ago, they already have it. So I guess the key is really how do we, as a market player or even as a family offices, that being able to deal with the tokenized asset and RWA, having said that, like this is something that is going to happen soon.
So 10 years from now, looking at your clients' balance sheets, what would it look like?
Well, I mean, first, what is asset?
Will it all be tokenized completely?
Yeah, if you just looking back to what I just mentioned, right? If I'm a private bank nowadays, what I'm doing, I'm basically giving you a statement in PDF, maybe monthly statement, right? On that, showing that my bonds, equity, fixed income, whatever portfolio, structured products that with my bank, right? But what we are looking at right now is basically if you are high net worth individuals, right? You should be able to, with a one click of button, not just willing, but investing into anything that being tokenized in the world. So private equity, I think, is one. You talk about real estate, everything that is doable. It might take some time for the verification and support by the regulation, right? But I think the fact that it's going to happen, and it's going to happen sooner than we thought, because adoption in blockchain technology is huge in finance already, right? So I think what we're expecting is get ourselves prepared, being able to survive, but not just competing with the capital here.
Okay. Well, building on the digital and tokenization and how the portfolios would look like, how is the mix of or the entry of robo advisors and automating those portfolios? How much of the clients are willing to have a digital background or a ChatGPT like fund manager / wealth manager, vis-a-vis having that human touch remaining? Where are we today, and where do you see this on the future?
We're very early.
Very?
Very early.
Very early.
Very early.
So people still want the human touch.
When it comes to
high
digital
touch.
assets, especially, 100%. 100%. Because it's a space that people do not, most institutions, if they have any exposure, again, it's very limited. So for them to do anything more, they're extremely, extremely cautious, and they want to speak to other institutions. They want to speak to VC managers or hedge fund managers and the founders and understand what they're actually investing in before they take the steps. And you saw a lot of people, I think, dive in headfirst back in 2021 and ultimately get burned by not doing their diligence and investing in things like BlockFi, Celsius, FTX, which were opaque. So at least when it comes to digital assets, and from what we've seen, it's next to none.
Yeah, I'll have a very different take on that. I have a 13-year-old son who loves trading and loves debating me, and his source is ChatGPT. His source is Grok. He researches it. He asks questions. And, I remember the good old days in the 80s, 90s, where, my parents or then my wife would just ask me simple questions like, how does this work? Today, they come equipped.
And nobody can challenge you back then.
With certain things. They wouldn't challenge. So today, the people have information on their fingertips. And then they converse and converse and converse. So while I'm not so sure, I agree with you that it's, you're not going to get multi-billion-dollar family offices running on AI. Financial literacy is going through the roof. It really is. And, I think it's going to get more. And actually, Trump's move last week to create the Dell-funded, child education funds, up to the age of 18, is really going to dramatically engage, young folks and people want to be in digital assets. They want to be in VCs. They want the next SpaceX or a secondary of SpaceX pre-IPO. It's not just mutual funds and ETFs, etc. I would argue the big stuff in the stock market has become so commoditized with ETFs that all the research and excitement is in the new stuff. When is the last time people researched stocks? I don't see that anymore like I saw it in the 80s and 90s.
Actually, more people, in my opinion, are researching stocks using ChatGPT. The friction has been removed.
Exactly.
Now, everybody wants to be in the know. Everybody wants to challenge the elders and the youngers. But the question here that I want to segue to the next question is, what's happening to the role of the CIO? Would you take that, Matt?
Yeah.
What's happening to the role of the CIO with financial literacy through the roof? I agree.
Yeah.
Everybody's challenging everybody.
Yeah.
You send a document or a PDF, as Ray mentioned.
Yeah.
I just forward from my WhatsApp to my ChatGPT. Tell me, what do I need to know? How do I challenge this guy?
Yeah.
This is exactly what ChatGPT is being used for.
Yeah. Well, maybe just to clarify. So what we do, the way that we work with clients is that we give them we just aggregate up the best access to different products on our platform, right? And so we are actually not making the market calls for them unless they want us to, right? And so with regards to specifically individual tokens, right? There's actually more information about these companies on a regular basis available using public blockchains than there is for traditional stocks, right? But at the end of the day, what they don't have is the insight to understand that a lot of the market movements is somewhat artificial. There's a lot of hedge funds, there's a lot of VCs that control a lot of the supply. And so to that end, goes to the fact that a lot of people that have been in altcoins have been down only, along with the broader market. But in general, where people are coming to us and asking for advice is with regards to specific funds. I mean, doing research on managers, which inherently is a qualitative practice, right? You need to understand like how they work, what are their operations, what custodians are they working with. You can't afford to lose money operationally when you invest into a fund. So that is where we're seeing people come to us, is finding the best access and the smartest people. It's actually less so on individual stock picking or ETF picking.
Okay, so Ray, back to you. How likely are family offices going to be outsourcing the CIO role? What's the landscape there? What is the structure of a family office? You said your clients are single family offices. What do they outsource to you, and what do they keep in-house?
Well, so I mean the same idea that we mentioned, right? The reason why I would say that the reason why family offices on investment, especially for the decision making, I would say that it's still pretty much very high touch. Which I mean, first, it's not going to replace by AI. Like, replace. For the serious money, for the big money that I think they're really under the family, you still want to control. You still want control. You still want your own vision on that. However, how do they actually utilize AI, as I mentioned earlier on, as a second CIO? I think it's quite important. Another example I give you, right? So last 2 years ago, actually, when we run our whole operation, right? So we have a team about 200 across few offices right now. About slightly more than half of them, they're basically investment team, our operation, and everything on that. I think we started with the ChatGPT, enterprise account about 2 years ago. And we train them to use it basically to do a few things, right? First, I think basically you cut down your workload on the KYC writing, you're basically processing on that part. And secondly, I think it's on research as well. Like, how do you actually keep everything in-house to do the research on this? So going back to the questions that we just talked about, like what are they trying to outsource to us? I think first, as a single family office, that you always have a problem with limited resources. Resources on capital, resources on timing, resources on anything, human resources that you basically cannot handle everything on your own unless you're like multi-billion or even more on that part. And even though you have that, right, you still wanted to have a second opinion sometime from professionals, like ourselves. So I think this is what we see in the future, is how to actually combine the technology, how to combine the AI driven data and also the report that you're going to have to speed up and doing more efficiently. Because I think in the future, as we always said, right? So, I mean, in the past, as a banker, right, an ex-banker, you always have a privilege of telling your client that what's your, your research report of a private bank or your Morgan Stanley, whoever, telling the client that was your target price of Walmart, right? In the past, come on, like it's nothing. It's no value at all right now. So I think it's the key of how efficient, how accurate the data you can have with the support of the AI that you have, so that you can make the right decision. Again, like going back to the family office point of view, they still want control. They want to control decision making at the end of the day.
Speaking of control, now you have these super apps coming out, and you have the winner takes all. Binance has more than 50% of digital assets, if I'm not mistaken. Coinbase is the second. And you have these big platforms. You have the Robinhoods of the world. You have different super apps coming out. And slowly but surely, you see even the buy now, pay laters, they start as a buy now, pay later feature. But as they collect the network, they move into, in some economies, they move into a banking license and they start taking the whole market away. And that circles back to the point I started with, is the number of asset managers is projected to be shrinking. So as the trillions of dollars go from the 100 plus to 200 by the end of 2030 or around that period, you have a lot of people that can outsource to themselves and have that control that you talked about. So control is a piece, and that's going to put a lot of pressure on the fees. So what's happening to the fee structure and the income generated by asset managers from your perspectives?
This is not a new thing. This is a secular trend emanating from the 70s, 80s, 90s. I mean, I can get you through all the different iterations of financial markets, the mutual fund boom, ETFs.
But has the 2 and 20 model been challenged more
Absolutely.
so than today?
Sure, because you can get private equity-like exposure. I'm not advocating our funds through ARC, through Cathie Wood. You can get allocations in secondary allocations in Twitter or SpaceX or etc. I have a private bank representing me in Dubai. They have all of them. They every month I can't keep up. They've got this private round, this pre-IPO round. So the fee structure of private equity, you don't need to be at Sequoia. You don't need to be at those 2 and 20. You can just sort of buy them on your own, and the security shows up in your portfolio. I've owned Kraken for a long time. Did I need to be a PE firm to own Kraken pre-IPO? No. So I think AI and decentralization and disaggregation of private equity is making the old fund structures, be it my alma mater Janus, that used to charge 100 basis points for active management, to slightly beat the index. I mean, the value propositions are just declining and declining. And now private equity, my space, is being challenged because 2 and 20, very, very difficult to justify in some capacities. Very difficult.
You guys all agree?
Yeah, I mean, if you look at the data that Cambridge Associates and a lot of these large allocators platforms put out, right, on average, to get a 3x net return in private equity or venture capital is phenomenal. 3x net, 3 times your money in 7-10 years. I don't think most folks want to be locked up for that long and get 1-2 times your money back. So what we've seen with regards to trends within managers in the digital asset space is if you actually strip back the returns of some of the best funds, a lot of it has been driven by beta. A lot of it's been driven by exposure to Bitcoin, ETH, and Sol. And now that you have the ETFs, which are obviously a cheap way for you to get exposure as LPs, for example, there's really no way that they can get away with allocating to beta and having you pay 2 and 20, which makes their job a lot harder, and you're starting to see dispersion in returns. So I would say in general, it's something that we challenge, and we try to, we've structured everything so that way it's all performance based on our end, and such that anything that we do, we don't take carry, we don't make fees, we don't make profit unless you as an LP do. And that's the way that I think you need to do it. You need to be aligned. You can't play this management fee game.
Ray?
Well, you asked me that. Actually, I think it's not going to, as I mentioned, right, it's not going to replace from day one, which means that I do believe that actually performance fee is still very much the key part that to basically differentiate between all the service provider, asset manager, and everyone. Because after all, right, if you think about what I just mentioned, right, if I am a high-net-worth individuals, right, I'm not looking to doing everything on my own because I have much more things that I want to do rather than looking into all these number and things. You know, I can spend some time in doing philanthropy, foundation, everything that is more meaningful for them. So after all, what they see is still, I want to make sure that I first diversify into different, allocation, as I mentioned, as an allocation, which means that, yeah, I can trust a robot to doing something, but at the same time, I want to invest into, some of us, right? Because ultimately, that's where our drive is from, right? How do you actually outperform the others? How do you actually get a better alpha? If not, that everything's going to be beta, right? At the end of the day. So I guess that's still something that as a manager in the future, you're going to differentiate yourself. But how, as I mentioned, how do you actually get more efficient? How do you actually be more visionary? How do you actually being able to diversify into maybe different jurisdiction, maybe different, continent that we're looking at? So one thing that so last month, actually in October, right, we have our annual forum, and one thing that we talk about, like what we had in past 10 years, like beyond, and what is a century beyond. One thing that we talk about is Africa. Why Africa? Because we look into the population, look into how the aging between African and also European as well as in Asia. The future is there. Like I talked to my daughter the other day, right? She's 10 years old this year. I said, like, there's something that you have to learn in my age, right? You have to basically be able to deal with Chinese. You learn Chinese, you deal with all this, right? Because it's a huge market. But in your age, obviously, you have to have a presence in UAE, Bay Area. However, the one thing that you might not, like it or not, you have to deal with also in Africa. Why? Because this is what we are expecting in the 20 years' time. So I think still, how do we actually look into this opportunity is still some differentiation between all the asset managers.
Thank you, Ray. So let me just wrap up and tie this all together and ask you one question, I'm going to ask you for a very short answer. What do you think in the next 10 years will not change in asset management? What is the constant that you see? Whether it's from an investor perspective, whether it's from the use of technology, as you mentioned, or whether the regulation, or what do you think is going to be something that's constant, that's not going to change within this industry?
That alpha will be very scarce and underperformance will be very prevalent, unfortunately.
That's been the case for 30 or 40 or 50
told me
years.
the next 30 years. So yeah, that will not change.
Okay. Matt?
Do you have one?
Well, it might, for me, right, one word maybe, it might be very traditional, but I think diversification. I mean, after all, you can say like how good like AI is, how good these gonna be, right? I think everything has to have a cycle and has to have a balance. After all, so I guess the easiest way to actually deal with it is like how do you actually play against US dollar depreciation? Everyone argue on that part, right? So I guess for us, it's about diversification.
This might be a hot take, but I actually think that the percentage of digital assets in people's portfolios is not going to grow as large as I think what some of the estimates are saying over the next decade. I think a lot of the allocation when it comes from institutions and family offices, it's generational. And so is the adoption of digital assets and AI and wanting to push the envelope. And so sometimes it does take a generational change to be willing to ramp up from 3 to 5 to 50% or 100% like some of us in this room, I'm sure are. So that's what I say.
Okay. Another question. In the next 3 years, what's your top priority in your asset management approach? What's your priority? What's keeping you alert? What do you want to do?
So as Naval says, attention is the new oil. So I have, it's not just I'm putting my
Branding.
My pocket where my mouth is. I'm betting heavily on attention. I believe in a world of AI or asset management, et cetera, without attention, it's very hard to create value.
I mean, this is going to sound pretty boring, but I'd say operational due diligence. I think that's something that you really cannot underestimate when it comes to the digital asset space. Right, again, there's no excuse for you to be losing money due to a third party risk. And so balancing counterparty risk, really ensuring that when you're making an investment, you know your counterparties, you know who you're investing with. There's recourse, there's a liquidation plan, et cetera, in place. Or if you don't know how to do that, working with somebody.
Maybe a little bit different, but I think for us, might actually be the right jurisdiction or regulation actually on the other hand. I think the key is because when we're dealing with traditional investors, there's still some limitation that we have to think about, and also the concern that they have, right? So I think the awareness of what is the best approach in the asset management for us is about the regulation, basically.
Last question. Where do you think you're going to make your alpha in the next short term?
Dubai chocolate. Dubai chocolate, a perfect example of a creation of the attention economy. Now that ship's passed. The next big company, the next big alpha are the things that capture attention and go viral, that don't have advertising, that don't have a CEO, that don't have things that we are traditionally used to.
Decentralized.
It's completely decentralized. That's how products and value is shaping these days. It is about attention. I'm not just shilling. So that's a product born out of attention and thrives on attention.
So your alpha is from attention on a product. Matt?
I still think that this is the right approach. This is an asset class that is so cyclical and so volatile that getting an index exposure to the innovation that's happening at the earliest stages is the right way to play it in addition to beta. And so I think it really is spending time with entrepreneurs, spending time with the VCs, and understanding who are some of the smartest founders and smartest investors in the room, and backing them and allowing them to make those calls.
But where do you get the alpha from?
By spending time with them and diligencing them.
More diligence. Ray?
So then I will bet on the digital asset. After all, the huge adoption is coming, right? So I think it is really about how do you capturing the next wave on that. And yeah, I think that's what we see.
Digital assets.
Yeah.
Okay, thank you very much. I want to thank my panelists. Please help me in giving them a round of applause to Wahid, Matt, and Ray.